Joining me now to assess the earnings story and growth questions in general is the founding partner of Alpha One Capital Partners, Dan Niles. And I tweeted about you last night, Dan, that you are the best in the business when it comes to technology investing. Thank you for joining me today.
It's always a pleasure to join the best in the business of what you do.
Oh, thank you so much. All right, so we are talking about worries about growth. You're very selective lately,
yes,
because you have your own concerns. Tell us how you're investing and what you think about growth and this narrative that things slow down in the next 2 years.
So I think you have to put it in perspective. I mean, if you think about the current market, this is the longest bull market in the S&P 500 since World War II. It's been up for 115 months. The gains over that period of time are up over 330%, which is the second biggest gain during a bull market since World War II. But if you look at the big picture around growth, you've got a lot of concerns. You've got China starting to slow down. Auto sales in China went from being up 15% year over year in April to down 10% in the most recent month. That's a pretty big change. You've got concerns over Italy and Brexit in Europe. And in the U.S., interest rates are going up. They're at the highest levels in 7 years. So all of these things are, have to be worked into multiples and your expectations going forward.
I think you make a really good point, because even though we're still talking about 3.2% on the 10-year, and give me a break, we've been at rock bottom levels for 7 years.
Yeah.
The speed with which this happens, shooting up to 3.2%, now the highest in 7 years, is a concern. And by the way, if I can get 3% in the 2-year, then maybe I say, all right, I'll keep my money in somewhere where I know it's safe rather than taking the risk of stocks.
Well, and that's a really excellent point, because if you look at the market, over a good portion of this run-up from the global financial crisis, you had S&P dividend yields today are 1.8%. For a good portion of this time, the yields on stocks and dividends were higher than the yield on the 10-year. So a lot of people said, well, I can't get any money in buying bonds, especially if you're in Europe where you had negative yields for a portion of the time. So they were buying stocks. Now if you go, oh, I'm a little nervous about the market, why do you care about a 1.8% yield on stocks when you can get a 3% yield on bonds, which are a lot safer?
Wow. So you're saying the average dividend yield for the S&P 500 is only 1.8%?
Yeah.
That makes a lot of sense, Dan. All right, look, we're getting the GDP report. This is the first look at the GDP for the third quarter. We'll get that number on Friday. What's your expectation there, and do you think higher rates cuts into that growth down the road?
Well, I mean, you bring up a good point, right? Q3 GDP is backward looking. I think the number will be fine. I think what you need to concern yourself with is the forward-looking numbers. And what you've seen in general during this earnings season, with Boeing being a pretty big exception, is that a lot of companies are guiding much lower. I'll give you an example. Texas Instruments reported last night, and I think they're one of the best indicators in terms of global health. They do about $16 billion in revenues, $100 billion in market cap. They missed revenue expectations for the first time since the fourth quarter of 2015. So it's been almost 3 years since they missed the top line. They talked about every major end market slowing down, and they weren't sure when it was going to stop. Analysts kept on trying to get them to say, oh, it'll be short, it'll only be a quarter, but they're like, we don't know, and this is going to last a while, because the upturn was so long in the making. So I think that's an interesting one to watch this morning.
This is a really important point that you're making, because Texas Instruments is not just supplying chips for one sector. Texas Instruments is selling out to the auto sector, selling out to the appliance sector, lots of different industries.
Exactly.
So if Texas Instruments slowing down, then that is indicative of what's going on in the economy.
And that's exactly right, because for a lot of companies, you're talking about one industry. So Boeing, you're talking aerospace, right? And it's great to see them doing well. When you're talking Texas Instruments, they supply into Boeing, but they also supply into Ford, and they supply into Apple, and they supply into Dell. And so they apply across a wide swath of the industry, and so it gives you a much better feel. That's why I think semiconductors are important to see this earnings season. And quite honestly, I think you're going to see 90% of them plus guide lower when they look at the fourth quarter.
Look at that stock this morning, down better than 6% on TI, and that really is the story of what's going. Do you think that are we looking at fundamentals deteriorating within technology?
I think you absolutely are, and this is exacerbated by the fact that you have a lot of inventory out there. So if you pick the biggest company in the world, Apple, for example, they have 89% inventory growth year over year in the June quarter that they reported. Their revenues were up 17%. Well, what if the iPhone doesn't sell well? they're going to have to burn that inventory off when we get into the March quarter. And if you think about, the sales of any consumer item in the fourth quarter, and you think about the big end markets, China's stock market is down about 20% year to date. India's stock market is down 15% year to date. And by the way, their currency is down another 15% depreciated year to date. And China's currency is down 6 to 7. So I think this holiday season, especially if you're trying to sell abroad, yeah, in the U.S. it's great. Our stock market's up 3%, NASDAQ's up 8%. That's wonderful. But if you're in one of the emerging markets or in Europe, you're looking at a very different picture in terms of how wealthy you feel.
It's a really good point that you make that Apple has all this inventory, because if you've got all this inventory and then you've got these economies that's worsening, who's going to pay $1,000 for an iPhone X?
Well, exactly. I mean, you look at last year, they had one phone priced above $1,000. This holiday season, they have 3 phones priced above that, and the average selling price, they're trying to boost it by another $100. The problem is, if you look at smartphone units overall, this will be the first year in history that smartphone units are down year over year. This will be the first year in history that China auto sales, at least as far back as you can go back to 2009, auto sales in China were up in 2009, despite the global financial crisis. They're going to be down this year for China. So if you look across a wide variety of end markets, you've definitely got some slowing. And Boeing is great today, but if you think back, yesterday, 3M stock was down 4% after they guided lower. Caterpillar stock was down 8%. Last Friday, the 4 worst performing stocks in the market were all industrial names. United Rental, Textron, etc. So I think this is stuff you need to watch going forward, and that's what makes me nervous, because valuations aren't that cheap across the board.
So what do you do then if you're watching this market trade nervously? Do you think cash is a place to hide for a little while?
Yeah, I mean, I joke that my favorite ticker symbol right now is CASH,
yeah.
But I realize there's a company with that ticker symbol.
Oh, God.
But anyway, yeah, I mean, our hedged products, we're sitting on over 15% in cash. And luckily, we went into this downdraft with a fair bit of cash. Now, we're looking to selectively deploy that, but that's after companies take down numbers further, and hopefully get to a level where we think, okay, you know what, that's a number that I can kind of believe. But semiconductors, for example, is a sector we would completely avoid until we get to the March quarter, because you've got all that inventory you still need to work through, at the same time demand slowing down.
You still like a couple of names, though.
I do.
You would be putting money into some Chinese companies, and you like Google. Yeah,
I mean, well, with China, let's be clear. I think pretty much every company in China is going to cut lower numbers because their economy is slowing down. So I'm looking to get more involved with those names after this earnings season, and the stocks come down even further.
Thank you for clarifying that.
So that'll be good. But yeah, I like Google a lot, because if you look at Google, their traffic acquisition costs have been going up for 3 years. They were up about 6% year over year in June of 2015. They did a new search deal with Apple. That was up 61% in the March quarter, and it's finally starting to drop. It was at 47 in June. So Google's one of the few that I continue to like.
Dan, it's great to have you on the show today.
It's great to be here,
Great
Maria.
analysis from Dan Niles, Alpha One.